Hi, I'm David Holland, and this is PlanStrongerTV. Welcome. On today's program, we're going to talk about reverse mortgage loans. Are they a good fit as part of an overall plan for retirement? That's exactly what we're going to talk about. Lucky you. Stay tuned. Let's get started. Welcome back. So, reverse mortgage loans, are they a good choice? There is so much debate or discussion or curiosity, wonder. I don't know, think of a few more ways to describe it. But the point is that I get asked a lot about reverse mortgages and whether or not they're a good idea. And so let me dispel some of the mystery. A reverse mortgage loan is a loan, it's a loan, it's a loan. It's a special type of loan that is primarily for people who are 62 or older. You have to be 62 or older. At least one person, if you're in a couple relationship, at least one of you must be 62. So it's for retirees or people that are approaching retirement. Now, a lot of people don't retire at 62, but it's for the people who are on the back nine of life, let's call it that. So it's for people who have a home. You have to have a home to do a reverse mortgage loan. You have a home and you have equity in your home, meaning you don't have it mortgaged all the way to its value. For people who are in that situation and they want to either eliminate and not have to make payments on their regular mortgage, or who want a line of credit, or who want to pull money out of their home and use it for something else, a reverse mortgage loan can be an option. Now, there are advantages and disadvantages, as I've talked about on this program many times. There are advantages and disadvantages with every financial product or tool. You always have to weigh cost, you have to weigh features, benefits, limitations. You have to weigh all of those things when you evaluate any financial product for your situation. A reverse mortgage loan is no different. But please remember, as we talk about this type of financial product, it's a loan. It's a loan, it's a loan. I'll say that a few times because sometimes people get a little twisted up in how it works. So you have to have equity, you have to have a home, you got to be 62 or older, and you should not and cannot be in a very bad financial situation because you have to demonstrate to the lender that you can pay your property taxes and insurance. So we're going to dig into this, but I want you to have a general picture of how a reverse mortgage loan works. You are borrowing money from a lender, okay? If you have an existing mortgage, you have to refinance and pay that existing mortgage off first. So if you have, for example, a home that's worth $200,000 and your existing mortgage is $100,000, you're able to borrow a certain amount of money on your home with a reverse mortgage, but you first have to pay off any existing mortgage. So you have to refinance the existing mortgage. If you still have some room left to borrow, and there's specific percentages that you can borrow based on your age. The older you are, the more you're allowed to borrow. But you have to have equity. You can't borrow the full value of your home. So in my example, if it's $200,000 that you have for value of your home, $100,000 is the existing loan, you refinance that with a reverse mortgage. The key thing that you accomplish is, unlike a regular home mortgage that you are required to make monthly principal and interest payments and pay your property taxes and your insurance, with the reverse mortgage loan, you don't have to make that principal and interest payment. You still have to pay your property taxes and insurance. So it's that flexibility that you get of not having to make the principal and interest payment that makes a reverse mortgage loan attractive for a lot of people. Now think about the alleviating effect that has. If you say your monthly mortgage payment is $800 and you're retired and you're on a fixed income. You might say, well, you know what? If I do the refinance with the reverse mortgage, I won't have that payment. That makes a lot of sense. Ease your cash flow, have more cash on hand. Now, are there disadvantages? Sure. That costs money to set up, and you are going to be having a debt that is increasing. Why is that? Well, you're not making payments against the principal or the interest. So, again, there are advantages and disadvantages. And this is just one example of how you can use a reverse mortgage as part of your overall plan for retirement, refinancing an existing mortgage. We're going to dive into this in a lot more detail. I'll go over some other uses of reverse mortgages, so stick around. Let's get started. Welcome back. So reverse mortgage loans. I spoke before about how you can use a reverse mortgage loan to refinance your existing mortgage on your home. It has to be your primary residence. You've got to be 62 years or older, and you can't be broke. And you know, that's one of the myths about reverse mortgage loans, is that they are for people who are broke. If you get a reverse mortgage loan, people say, oh, what happened? Is everything okay? It used to be, once upon a time, when these products first came out, they were marketed, and a lot of people who got them were people who maybe were in a more difficult financial position. But today, the product has evolved a lot, especially since 2010, when they came out with a lot of the banking regulations and lending regulations that changed. The loans are less expensive. They are even more regulated. The requirements are more strict. There is consumer counseling that is required. And they also did a lot to raise the bar on mortgage brokers and who is actually involved with lending money and acting as a broker or a loan originator, helping the consumer get the reverse mortgage loan. So myth number one, it's for people who are destitute. Not true anymore. It's really for people who want to have a reverse mortgage loan as a backup or to refinance their existing mortgage so that they have more flexibility with paying their principal and interest payments each month. Now, the other very common myth about reverse mortgage loans is that the bank gets your house. Now, I suppose that also started back when these loans first came out, but today, the way a reverse mortgage loan works is it's a loan, it's a loan, it's a loan, and it works just like a regular mortgage if you die. So if you die, whatever the value of the house is and the loan, that's what is dealt with at that time. So again, back to my example, if your home is worth $200,000 and the reverse mortgage loan or a regular mortgage is $100,000, you've got the same options. Your heirs sell the house and pay off the loan. The heirs refinance the loan and keep the house, okay? Or decide some other arrangement with this financial aspect of this, but the bank doesn't get your house. Now, for a lot of people, they look at a reverse mortgage loan to be used in other ways besides paying off that existing mortgage. Because a lot of people, their goal in life, the American dream, is to arrive at retirement without a loan on their house, to own their home outright. But I'd like to go over a couple of other ways in which a reverse mortgage loan can be used, and you can leverage that equity in your home to accomplish other financial objectives. So let's dig into that. For a reverse mortgage loan to be a tool and to be able to access the equity in your home, you first have to have what? You have to have equity. So again, my example, a $200,000 home, that's the value. If you don't have a mortgage on that home, that's great. You've got $200,000 in equity. Depending on your age, you can access part of that equity and cash it out and use it for something else. You say, well, why would I want to do that? The house is paid for. You might have another need. For a lot of Americans, when they arrive at retirement, the value of their home and the equity in their home represents a large percentage of their net worth. So that's why people really work hard to pay off their loan and to have a home that's free and clear by the time they reach retirement. Now, in today's world, with the reverse mortgage loan becoming what it has, it is now a tool, it's a financial tool. And so in addition to using a reverse mortgage loan to refinance an existing loan, If you don't have any debt on your home, here's a couple ways you can use a reverse mortgage loan. You can get a line of credit using a reverse mortgage. You say, well, how's that different? I'm glad you asked. You can have a regular home equity line of credit that most people are familiar with, which is a line that you can establish on your home with a bank, and you can use it kind of as a backup emergency fund, and you can draw on it with checks, or you can go get a draw from the bank, and you draw that money out, and then you pay interest on that loan, and at some point there's a balloon or a renewal date, and you've got to either refinance or pay off the home equity line. Now, the bank can also freeze your line, or it can not renew your line. So a home equity line is something that a lot of people are familiar with, and it's got its advantages and disadvantages. A reverse mortgage line of credit, you have a HELOC, home equity line of credit, reverse mortgage line of credit, I call that a RevLock. With the RevLock, it's very similar in that you are borrowing against your home, you have a line of credit. The big difference is that the lender can't cancel your line, they can't freeze it, and the line is available for draw, and when you pull money on that line, you don't have to make interest or principal payments during your lifetime. So that's the key difference between a reverse mortgage line of credit and a home equity line of credit. You don't have to make principal or interest payments. You say, well, when would I want to do that? Why would I want to do that? There are a lot of reasons. I actually recommend fairly often that people consider a reverse mortgage line of credit if they don't owe anything on their house, to take one out, establish it, and have it as a backup. What do you need it for? Well, you might have an emergency, okay? Something may come up where you need to access money and you don't have enough cash on hand and you don't want to have to liquidate your investments. Let's say that the stock market has fallen in value by 40% like it did in 2008, and you've got an investment portfolio and you've got some cash, but you need more than the cash you have on hand, and you look at your investment portfolio and you go, gee, it's not a good time to take money out of my investment account. If you have the reverse mortgage line of credit, you pull on the reverse mortgage line of credit, draw that, use that money. It's going to cost interest, of course. You don't have to pay it. It's added to the loan. And then what you can do is you can draw that money and wait. The patient investor wins. Wait until the stock market hopefully comes back up. And when it comes back up, then you can liquidate enough money to pay off the line of credit. So if it costs you some interest, fine. That interest is going to be a lot less than taking a 40% hit in order to get cash when you need it for the emergency. Now, there are other uses for the line of credit that I like, and this is why I recommend it. It can be a backup for people that have long-term care needs in the future. Let's say that you've wisely purchased a long-term care insurance policy. Well, what if that policy doesn't keep pace with inflation? What if your stay in a nursing home is longer than your long-term care policy allows? You know, maybe you've got a 3-year policy, and after that 3-year period, there's no longer any benefits from your long-term care insurance policy. The reverse mortgage line of credit can be a backup after that. Again, it's a tool. It's a backup plan. You also might want to draw the money out on the line of credit to use it for some other purchase or some other expense. And it's nothing wrong with saying, you know what, I've wanted to go on a cruise or I want to travel. I've never been able to do that, and I've worked hard all my life. Maybe some things haven't turned out as well as I've wanted them to. Maybe you haven't accumulated as much as you would like in your investment accounts. Maybe you're not getting as much in Social Security, whatever the case may be. It's your home. You worked hard. There's nothing wrong with using some of that money to meet other expenses. Or maybe you're trying to stay in your home, plan ahead, stay in your home instead of needing to go into an assisted living facility or into another care setting, and you want to make modifications to your home and you need the money. Maybe you need a new roof. Maybe you need a new kitchen. These are all things that people use the reverse mortgage line of credit for. Now, I'm not telling you all this to go on a spending spree. I just want to give you an example. Here's another one. Back to my example of the $200,000 home and a $100,000 line of credit. If your home is worth $200,000 and you can pull out $100,000 using the reverse mortgage, Generally, it's about half that you can get access to, and if you're older, it can be more. But let's say you can pull out $100,000 with the reverse mortgage. You don't have a mortgage payment now. You do the line of credit. You still don't have a mortgage payment. You can make payments if you want to on the reverse mortgage, but you're not required to. You've got this $100,000 line of credit. Still no mortgage payment. You can use that money maybe to buy a rental property, something that is income producing. So we've taken equity that's not really making anything for you. It's certainly not giving you cash, and you now turned it into an income cash flow for you. That's not a bad strategy. Now, of course, you have the loan, and of course, you are accruing interest that at some point is going to have to be paid. But a lot of times in retirement, the name of the game is cash flow. Cash is king, they say. It's true. So being able to juggle and pull money and be able to access this funds when you need them, there's a lot of advantages to having a backup plan. And there's one more use of the reverse mortgage that surprises a lot of people. You can use a reverse mortgage to purchase a home. Say what? Here's exactly how it works. You have a home. Maybe it's the wrong size, too small, too big, wrong location. You want to move closer to family. You want to move to Florida, which is a great place to be. You want to change your lifestyle. You sell your existing home. You're going to buy a new home, for example, in Florida. I've done this for somebody. So they moved from Colorado to Florida. They bought a home in Florida. They put part of the money down in cash, and they used a reverse mortgage loan for the other half. So it's no different than buying a home with a regular mortgage. The difference is that you have to make a larger down payment. Again, it's roughly half that you have to put down, and the other half the lender puts down. Now, the key difference, you don't have to make mortgage payments on that mortgage you use to buy the home because it's a reverse mortgage. You still have to pay property taxes. You still have to pay insurance. You have to maintain the home. So what did that person accomplish? They were able to keep a lot of the money they had from selling their other home, and they got the new home, and they don't have payments. Yes, they're going to have to pay that at some point in the future if they decide to sell. They have to pay the principal they borrowed plus the interest, or when they die, their heirs will then, of course, be in the same position where they'll either have to sell the home or refinance it. So the reverse mortgage loan is a tool. It's like a lot of other financial tools. You just have to evaluate it for your situation and see if it makes sense. There are requirements. There are steps you have to take. There is underwriting. You work with what is called a loan originator, like getting a regular mortgage. And not every bank or institution offers reverse mortgage loans. You'll have to look up or find one in your area, somebody that specializes in reverse mortgage loans. But there are a lot of advantages to incorporating it into an overall plan. I recommend it. It's not for everyone, but it isn't a bad idea to have as a backup. Now, I believe in the reverse mortgage loan as a backup that I recommended it to my mom and dad. So they established it for them. Now, they don't need it, but I recommended that they get it. So they have investments, they have annuities, they have cash on hand, they have the reverse mortgage loan as a line of credit as a backup, just in case. So you don't have to have a son that's a financial planner to consider a reverse mortgage loan as part of an overall plan. There are costs that have to be considered, just like any other financial product or a loan, but consider it and evaluate it for your situation and see if it's a fit. And I think if you do that, you'll plan stronger. Okay, time for viewer questions. You know what to do. You can email me your question. I can answer it on the program. I will change your name. I will change facts about you if you've asked me a detailed question so that nobody knows who it is, okay? Feel free to email those to me, and I'll be happy to answer them on the show. All right, quick question from Bob in Maine. Good question, Bob. This is a great one for a lot of people. Question is, what can I invest in that is very safe? I want to earn money, of course, but what choices are available to me that will protect my money? The truth is, Bob, not a lot of choices. Here they are. Ready? Don't even need a pencil and paper to write it down. Here they are. From the banking world, CD, money market, savings account, checking. That's it from the banks. From the insurance world, 2 types of annuities. Fixed annuity, index annuity. That's it. That's all we got. How about bonds? Yes. If you hold the bond to maturity, and if the issuer, the company issuing the bond, or the government is still there, okay? So the quality, the rating of the bond matters. Bond mutual funds, not as much, because if interest rates go up, the bonds can go down in value, and the bond mutual funds don't necessarily hold those bonds to maturity. So those are your choices. A lot of choices for investing that have risk, but the choices that are not as much risk, they're limited. All right, send me your questions. I'll answer them on the show. Before you go, I've got a great story for you I've been meaning to tell you, and it's a fun story. I got an invitation to go over to the local elementary school, and it was career day. And so they wanted me to come and talk about what it means to be a financial planner. And so these are elementary kids. I think it was 4th and 5th grade. So how do I communicate and share what a financial planner does with 4th and 5th grade kids? What, are they 10, 11 years old? So it was fun. I decided to use a board game, Monopoly, as a way of describing what a financial planner does. So I went in the classroom, teacher introduced me, and I asked the students, I said, how many of you have played Monopoly? And all the hands went up. Any excuse to get excited, right? All the hands went up. They're very excited. I said, how many of you played Monopoly 10 times? Hands went up. How many have played Monopoly 100 times? Everybody's hands are still up. I said, how many of you have played Monopoly 1,000 times? There's still a few holdouts, okay? Nobody wants to put their hand down. Finally, I said, how many of you have played Monopoly 1,000,000 times? And they all reluctantly sat down. Darn it, he got me. So I had their attention. I said, well, being a financial planner is a lot like somebody who's played Monopoly 1,000,000 times. They know how money works. And so imagine if you were playing against somebody who has played 1,000,000 times. What would that be like? And the kids were like, that wouldn't be fair. And, oh, they'd know what to do. They'd be the boss. And they just rule the game. And then one kid's like, my cousin's done that. I'm like, okay. So, but the neat part of the story was I said, look, when you've played Monopoly 1,000,000 times, you're very good at it. Or you should be, right? So a financial planner is like that Monopoly player. They know when to make the right decisions. They're smart with money, when to buy the property, when to put hotels on it, when to make a deal on trading one property for another. So, and that got me thinking that, you know, we all need that kind of Monopoly player experience in our lives, not just with finances. Of course, with finances, it'd be great, right, to have somebody who has that level of financial expertise and acumen to make the right moves because they have a lot of experience and training and education and credentials. That's all great. And we need it in other parts of our lives. You know, when it comes to your car or your house or your health, all these other things, we need people who have that level of expertise, who have that level of dedication and experience. And so as you think about your finances and you make choices and you make decisions, don't be afraid to find that 1,000,000 player Monopoly player. Don't be afraid to find that person in that particular area that you need help in, someone who's had that experience. And if you don't feel like you're getting that type of advice, that kind of skill level, then don't be afraid to look at other choices. Don't be afraid to get a second opinion, because after all, it's your money and nobody cares more about your money than you do. Thanks for being with me.
If you would like more information about the topics and our guests featured in this series, please visit our website at PlanStrongerTV.com. Also, if you have a question you would like David to answer, please send it to questions@PlanStrongerTV.com.